Welcome to Kitchen Table Finance.
Good morning, Mr. Shotwell. How you doing today?
Not bad, Cole. How are you?
Hanging in there, trudging through the last of the gloomy Michigan spring. Hopefully, finally
Let's
get some
hope
sun here
so.
soon.
Let's hope
Yeah,
so. We're supposed to get a pretty good storm tonight, mostly ice, it sounds like. So
that's the joys of living in this wonderful peninsula. I know that for me today in the Lansing area, it's supposed to be in like the mid 60s, and you're going to get a nice storm.
Yeah, we're going to get a nice storm. It's just the way of the world. As a client pointed out to me yesterday, you do live there by choice.
Yes. Yeah, that's the joys of being a little bit of a recluse. You get to live in the middle of nowhere, but there's a reason why nobody lives there. Right?
That's right. Live from the compound. We'll see sunny skies here in a couple days, I'm sure. I have hope.
No sky's sunnier than talking about withdrawal strategies, though.
That's right. Let's get cooking on some retirement planning. So last week with Nick, we talked about putting the pieces together for retirement planning kind of on a high level, talked about Social Security, pensions, then, obviously supplementing that with retirement savings. This week, we're going to jump into a little more detail about how we go about actually taking withdrawals from those retirement accounts.
Yeah, and I think it's a really nice topic to go over because a lot of the client meetings that I've sat in on where, we have people who are transitioning from working into retirement, that's a really big question that they have as to what does that actually look like? Where are we taking money from? How much money do we take? And I think that's really some of the great value add that advisors can actually bring to clients is helping them piece that together.
It's a little difficult because no client's scenario is exactly the same. So we're going to talk in some generalities here and do the best we can. Just keep in mind that there's no one size fits all answer, and that's why we have the company that we do. So
seems like that's a life theme. You could probably do a couple different things here.
Yeah. You're never going to get an easy answer from any source. What we're really talking about when we talk about withdrawal strategies is looking at the mix a particular person has of different tax treatments for their different accounts that they're going to draw from during retirement. There's after-tax savings, which usually includes bank savings, in terms of how the tax treatment is, but also then regular investment and brokerage accounts, often referred to as non-qualified accounts because they've got no special tax treatment. So just an investment account, mutual funds, things other than IRAs, Roth IRAs, 401ks, 403bs, just general savings.
Sure. For those who are not aware, obviously part of the after-tax game is that those are taxed at capital gains rates, whereas traditional IRAs and Roth IRAs are taxed at ordinary income, which is a less preferable tax system.
Right. Another way to put it, you're going to pay tax on the interest and dividends that those accounts produce, whether it's a savings account paying interest, a stock and bond portfolio paying interest or dividends. Now, we often use tax-free bond funds in those after-tax accounts, so it's a little bit subtle. But then, yes, if what you're doing is liquidating stock and bond funds, you're paying capital gains at preferred rates, and the money you put in originally that you've already paid tax on comes back to you tax-free. So just in a nutshell, if you put $100,000 in a stock mutual fund and it's now $200,000 and you liquidate it, you're going to get your $100,000 back with no tax. And then the growth is taxed at capital gains rates. So that gives us a lot of little levers we can pull in terms of how you're taxed during retirement on those kind of accounts, things we can control to a certain extent. And then the next category, and probably for most American middle class retirees, the biggest category is pre-tax savings. So that's money, it's often referred to as traditional IRA or traditional 401k, 403b money. It's money that you put in while you were working. It was deducted from your W-2. So you did not pay tax on that income when you earned it. It went into the account tax deferred. But when it comes out of the account, it's taxed $1 of income for every $1 out.
I'm sure as we talk about Roth stuff too, some of the overlying theme of this is that it's good to have a mix, right? It's
right.
It's good to make sure that we aren't super overweight any one of these specific investment categories.
That's the best thing for our retirees is when they have a good balance across these different types of accounts, because then we can control the taxes to a certain degree. It's diversification of tax treatment the same way we tell people to diversify investments themselves.
Exactly.
The third category is tax-free savings, and that's usually Roth IRA or money that was put into the newer Roth 403b, 401k options, where that money was taken out of your paycheck to deposit into the account, but was still counted for tax purposes in the year you earned it. You pay tax on it on the way in, but it grows tax-free and is tax-free during retirement as long as you follow all the rules.
And going back to the diversification of the tax treatment, I think it's something that's really easy for one, a lot of people don't really understand the differences. But for two, it's really easy to get caught up in strictly returns and long run things like that. But like you said, really what you're doing when you're making either a pre-tax contribution to a traditional IRA or a post-tax contribution after tax to a Roth account is you're either making a bet that you think that you're going to pay less taxes in the future if you have that deducted today, or you're making a bet that you think the rates are going to be higher and you want to pay the tax now. And so that's, as Nick always says, who I'm in the chair of today, is that we really don't know what taxes are going to be like in the future.
Right.
So as a result, in the same way that we'd like to diversify our portfolios, because I can't tell you from one year to the next what asset class is going to be gangbusters and which one is going to be in the toilet. I don't know if rates are going to be a lot higher or a lot lower in the future.
Yeah. Well, and to add another layer of complexity to that is when you're in retirement, when you reach your mid 70s now, you have to start taking a certain amount out of your pre-tax investments, but you do not have to take a certain amount out of your tax-free Roth accounts. Kind of segueing into like how we try to think about these strategies. And this happens a lot where people diligently save while they're working on the premise that they're earning more in their working years and being taxed at a higher rate in their working years than they will be in retirement. They cruise into retirement having been diligent savers and having taken advantage of several decades of good market returns overall. Then those required minimum distributions in their 70s may actually mean that they're having to take money out and pay tax on more money than they need to, and can potentially right now, with tax rates where they're at, end up in nearly the same tax situation in retirement as they're in while they're working. If you're saving for retirement still, if you're in the pre-retirement phase, think about that. That's one of the things we look at when we're working with younger clients is what's a logical mix. We're not going to say the right mix because, as you and Nick point out, we don't really know what the future is going to hold, but let's come up with a logical mix for you based on what we do know and what we can kind of expect to try to avoid being stuck with a withdrawal strategy that we're kind of shoehorned into later in retirement where you're having to pay more tax than you want to.
Sure.
Those are the three main players in terms of accounts, and then putting together a withdrawal strategy across retirement is usually about how do we minimize taxes as much as we can and end up in the right place for the client in terms of the income they want to receive across retirement, not just in a given year. Right. So kind of the default like rule of thumb thinking in financial planning has always been, spend your after-tax money first, let your pre-tax savings, your traditional IRA, 401k savings grow, and then take that next and leave your Roth money to grow tax-free as long as you can. And take advantage of that tax-free growth over the longest period of time possible. That works for a lot of people, but usually the answer ends up being a little more nuanced, right?
Yeah, no, it definitely does. As we kind of mentioned, most people who have a workplace 401k or contribute to a traditional IRA, it's much more common that we find clients and prospects that are really, really heavy into the pre-tax accounts, which is not inherently a bad thing, but it does mean that as you get older, those RMDs that kick in at age 73 can start to be a huge chunk. And then almost always, for most of our clients, way more than they actually need to sustain their lifestyle. So you're both taking money out of the market and potentially missing out on future gains, while also paying potentially a higher tax rate than would normally be necessary for someone in your situation to be paying. So it really becomes a game of Well, if normally we'd be taking money from our after-tax accounts and we'd be, looking to make Roth contributions or something like that, that's where things like taking money out of existing IRAs that we have all this pre-tax money in pre-age 73 and starting to make some of those backdoor Roth contributions, which a lot of people have heard about and read about, to try to minimize those future RMDs so we can have a much better handle on controlling our own income in retirement.
Yeah. We like to think of retirement in phases, really. We're going to have to talk generically, but let's say, for a hypothetical kind of a normal sort of client that we work with, they'll have a mix of those three different account types, but yes, usually the emphasis has been on their 401k, and they have the most of their money is in their pre-tax account. The phases of retirement then would be that period of time from when their paycheck stops through when they need to start taking money from their IRA, either because they've used up all of their after-tax assets or because they've hit required minimum distribution age, one or the other. What we're hoping is there's a window in there where they've got after-tax investments that they can spend for a few years before they have to take money from their IRA. And so a typical situation, let's say they need $4,000 a month from their portfolio to go with, Social Security, pension, all those other pieces we've talked about. If we can take that from an after-tax account for, say, 5 years before we have to start taking from their IRA, they're going to end up in a really low tax situation during that first phase. What we do every year then is we look and say, okay, if we're going to pay some capital gains on that money coming out, but we're not paying income tax on anything other than, some interest income, then that gives us a very nice amount every year that we could potentially take from their pre-tax savings and move into a Roth IRA, paying those taxes now. Say, we work that out with the client. It depends on their goals and their particular situation and mix. But, maybe we can take, $40,000 out or $50,000 out of their IRA this year, not spend that money, spend money from their after-tax investments, put that money in their Roth. Maybe they're paying 12% taxes now on that, where, if we did nothing, they'd be in a 0% tax bracket. They'd probably feel pretty good about that, but they're kind of missing out on the fact that then all of a sudden in retirement, later on in retirement, they may end up in like the 22 or 24% tax bracket because now they've got to take a lot of money out of their IRA. So our withdrawal strategy will kind of shift over time, but in an ideal situation, we've got those first few years, we take after-tax money and take advantage of that low tax scenario to then do those Roth conversions, reducing what their future taxes are going to be.
Another thing to consider too that I've heard a lot of clients talk about, and Nick likes to talk about this too, is that generally speaking, as you've talked about, the Roth money is the last money that we touch. And so usually that Roth money is money that is going to be an inheritance and a legacy for your beneficiaries. So some clients like to look at that as kind of their lasting gifts, where it's like, I'm going to make these conversions. I'll pay the tax for my kids, essentially. And so you can have this nest egg that I built for you. And it isn't going to negatively impact your own tax situation in your working years.
Right.
Because especially if you're a client and you have kids that are working, maybe they're making really good money, then suddenly all of that money that's in your pre-tax IRA that you have, that they're going to have to take out over 10 years when you pass, suddenly that money is getting taxed at a much higher rate than it might need to be otherwise.
Yeah. Let's just use $100,000 because I like round numbers. Let's say we can move $100,000 from your IRA to your Roth IRA this year and pay 12% taxes on it because you've got, your standard deduction, no other income, whatever that number is. So you've essentially spent $12,000 in tax to move $100,000. And if you do not need that money during your lifetimes, your kids inherit that. They may be still in their working years. Maybe they're in the 24% tax bracket, maybe higher. You've essentially given them an extra, plus growth, but it just assuming it just stayed the same $100,000, you've given them an extra, 12 on top of that. In a way, is a useful way to think about that. So when it comes to fine tuning these things, is it worth it for you to pay 12% taxes now? Or is it worth it for you to even pay 22% taxes now? And we have to take into account Medicare premiums, all kinds of different things that change with income. At what point is it worth it for you to pay that tax? is going to kind of vary depending on whether that's still money that then you're going to use during your lifetime, or money that's going to grow potentially not just for your lifetime, but maybe 10 years beyond in a Roth for your kids. All of these different variables have to come into play, but that withdrawal strategy needs to be thought about really every year as you move forward, because as the after tax part of the puzzle gets smaller and you get closer to required minimum distribution ages, we start shifting how we think about where your money should come from.
Yeah. And I think about this often too, is that, it's pretty easy to associate the world of financial planning with, I've got this money. How can you help me make more money? Right. Which that
Right,
is part of it.
right,
But
right,
a big aspect of it is that for everybody listening to this podcast, the largest expense that you'll ever have over the course of your life is taxes. And
right.
so
Yeah.
So having somebody who can help you navigate legally,
Hmm.
ways to reduce your tax exposure, to make the smartest tax decisions that you can, to get the most out of your income. And so your beneficiaries can get the most out of your income when you're gone. I mean,
Hmm.
that's, to me, maybe even more value than, invest in this or put your money in this fund or this ETF. And I think
Right.
that's really where we can help a lot of folks.
Yeah. It's pretty rewarding to see how that can play out when you're talking, sometimes you're talking significant tax savings depending on the
Yeah.
client's situation. You can be talking about some really significant dollars over their lifetimes.
Yeah, well, I know that we've been showing a lot of our clients the new software that we've been using called Income Labs, this
Hmm.
spring search that we've had. And what's been really fun working with that program is that, especially for clients that are, I don't know, let's say maybe they're 60 years old, so they're going to have kind of a long runway pre-age 73 to make those Roth conversions that are
Hmm.
really heavy in that pre-tax money. It can give some projections using kind of average returns and things like that over the course of their lifetime, to where, let's say you live to age 90 and you're making these Roth conversions up to this tax rate, blah, blah, blah. It's like you can
Right.
save huge chunks of money in taxes. But if you weren't working with a planner that knew how to do those things,
Yeah.
you'd be missing out on.
Yeah. Along those lines, a couple times over the last couple of years, I've had folks roll in to inquire as new clients like right before required minimum age, and that's kind of what's prompted them. Like, I've got required minimums next year, should I do a Roth conversion this year? Well, you had 8 years to be doing Roth
Mhm.
conversions. Now trying to cram a significant Roth conversion to make a difference into 1 year is going to cost you more in tax than if you had spread that out over that whole time. So this needs to be an ongoing process right from the beginning to make it work right.
Well, it's the old quote of the best day to start investing was yesterday, but it's like the best
Right.
day to start
Yeah.
tax planning was yesterday.
Yeah. Yeah.
Next
Yeah.
best day is today.
Yeah.
So
Yeah. You can just group it all under financial planning. Best day to start it was yesterday, or the next best day is today. So
absolutely.
there you go. The other thing too, while the withdrawal strategies need to be dynamic every year and thought about in terms of what's my tax situation, what's my mix of assets look like this year, how do I maximize that, is then the asset allocation becomes dynamic too. When we talk about asset allocation, we're really talking about the risk that you're taking. We look at that across the spectrum of accounts. And as you're starting out in retirement, then if we're spending that after tax part of the portfolio sooner, you can take a little more risk in your pre tax IRAs early in retirement, but then start dialing that back. As the after tax part of the portfolio gets smaller, you may need to make the IRA then that's next up be a little bit more conservative so that you're not in a pickle with a down market when you need to shift to that. And then a lot of times, because Roth IRAs are going to be the last money a client spends, if not go to the kids, that's where we can say, to a client that's so inclined, here's where you should take your risks, because that money, that growth is going to be tax free, and it's got a longer time horizon for that to play out. So these things kind of all play together. Yeah.
And like we said at the beginning, it's not a one size fits all solution. There's some good
Hmm.
principles and there's some good general strategies to have, but
Hmm.
further adding to the importance of making sure that you're working with a quality fee only financial planner that has the tools and knows how to do these things.
Yeah, and works over the course of your retirement. I guess to close it out, the main thing about withdrawal strategies is it emphasizes that financial planning is a verb and not a noun, right? It's
Yes.
something that we do ongoing. It's not, you don't get a financial plan, you do financial planning because it's going to be different every year.
Yeah, we live in a dynamic world. The only thing that is constant is change. So
That's right. That's right. If not the markets, the rules. If not the rules and the markets, then somebody's personal life circumstances will change. Usually, all
absolutely.
three.
Yeah, well, thank you very much, Mr. Shotwell. I've really enjoyed this. Anything else you want to add at the end?
I think we covered it. Stay warm, stay inside as this ice storm comes through, and I guess it'll probably be sunnier skies by the time this is published anyway, so we won't worry about it.
Yeah, absolutely. Well, and I always forget, is it info at SRB Advisors? Is that the email they can reach us at if they have any questions?
That's the easiest one. Yeah,
That's the easiest one.
yeah,
Absolutely. Or you can
yeah.
always give us a ring. We'd be happy to hear from you and answer any financial planning questions that you may have. Yeah, hunker down. Try not to get iced in. Hopefully you got
Yep,
the gas on the generator. And
yep,
I'll see you next time.
yep. Thanks, Cole.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.